Welcome to the Monocle Banking Podcast, where we dive deep into the world of finance, economics and policy with some of the most influential voices in the industry. As always, it's a pleasure to be here, your host Michael Avery, and today we've got a super special episode lined up for you. So whether you're a financial professional, you're an enthusiast, or someone who just simply wants to stay informed about the world of finance, you've come to the right place. Well, today we're joined by a true pioneer in digital banking, and I think the words pioneer sometimes get thrown around a little bit too liberally, but Coen Jonker, the CEO of TymeBank, is certainly that. His journey from founding Tyme as a mobile money remittance operator to leading it as one of the fastest growing digital banks in the world is nothing short of remarkable. With over 9 million customers in South Africa, 3 million in the Philippines, TymeBank is redefining financial inclusion and digital banking, and what this new world, this new era of banking truly offers in terms of digital inclusion, financial inclusion and economic enablement. Coen, great pleasure to have you on the show.
Michael, good to speak to you.
Now, what I've always found fascinating about your story and your journey, Coen, is it is anything but typical, because you've had an impressive career, but you've spanned various roles and industries. You've got 2 law degrees, and you were the CEO of Edward Nathan before it became ENS. So clearly, when you were younger, you saw yourself as more of a lawyer than a banker. Just tell me a little bit more about where you grew up and what shaped your formative years and then your initial love of the law.
Michael, yes, I grew up all over the country. I ended up going to 8 different schools growing up. My father was a minister of religion, and in those times, the church would sort of move them around every 3 or 4 years. And so got to know and love the entire country, but ended up finishing school in Bloemfontein and doing university in Bloemfontein. And I originally wanted to study philosophy and sociology and psychology. And my father simply said he's not going to sign my student loan forms if I don't study something that is potentially useful to society. So I picked law that sounded quite close to those things. And I just loved it. I loved the rigor of it. And also at the time was very involved in student politics at a time when the world was adjusting to sort of putting apartheid behind us. I canvassed at the University of the Free State for a multiracial campus and a multiracial reses on campus. And now it sounds almost weird. It's almost surreal to think that there was a time when that was a debate.
So was that the early 90s?
Exactly, late 80s, early 90s. Got really interested in human rights and jurisprudence, philosophy of law, and actually started my first job after university was actually teaching human rights. But then when I got out into the real world, I very quickly realized in my 20s that if I want to make real money, commercial law is where the world is at. So got into labor law, employee benefits law, and then M&A, and ended up, as you say, in my early 30s, actually being managing partner of the firm for 5 years.
It's a fascinating career path, and one that quite clearly sees you very interested in the human condition. As an aside, my second major was sociology, but my first love was journalism, so I had to pick something else, and sociology intrigued me also in my 20s when I was perhaps a little bit more naive around the way the world works, and that also changed quite quickly as one enters business, and you just realize how you can change a system that is fundamentally driven around economics. So I just want to find out, in that period that you were at ENS, I know at that stage, it was probably around the mid-2000s that Michael Katz, who founded the firm, sold the firm to Nedbank for, 400 million, and then ended up buying it back for 40 million because most of the senior partners left. Was it through that period?
Exactly that period. So I became managing partner just shortly after the transaction was concluded, where Nedbank acquired then Edward Nathan Friedland, and sort of ran it all the way through and actually led the negotiations with Tom Boardman on the other side negotiating for Nedbank when we bought the business back.
Fascinating. And if you look at it, was that potentially one of your first forays into negotiations around building businesses, acquiring and selling and that kind of thing, that first piqued an interest in then ultimately developing Tyme?
Yes, it was an interesting time in law and in advisory generally, because when we did the original deal in 2000, We had a view of the future of advisory services and that it was going to become integrated advisory services where law and corporate finance and M&A integration would all be like a one-stop shop.
Yeah.
But then the Arthur Andersen collapse happened, the Enron collapse happened, and the whole world changed its mind on this idea of integrated advisory with a very strong shift back to arm's length, independent advisory. And so the whole premise of the deal of having a law firm inside an investment bank essentially fell flat. And I think it was a big lesson in the importance of context for business. Even now, looking at our business and what we've done in financial inclusion and digital banking, it's this combination of competent, hardworking, ambitious teams, but also what happens in the world around us and the extent to which the combination of regulation, technology, and this changes in the social contract shapes where success and failure happens in history.
And why one needs to be acutely aware of that context that you mentioned and which way the contextual winds are blowing. You then, I think it was in 2005, left legal practice to join Standard Bank as a director of community banking. What shaped that decision?
I was in the first MBA class at Gibbs in 2000 and 2001. And Nick Benedell, who was at the time the dean of the school, was the founder of Gibbs, taught us strategy. And in that course, I came across a number of, at the time, cutting-edge thinkers, particularly a Peruvian economist by the name of Hernando de Soto.
Yes.
And a business school professor by the name of C.K. Pralad. And back to the point you made, Michael, around sort of interest in the world and the context. What struck me reading these guys is that there is a unique opportunity for private sector business to actually drive transformation in society, and that it can be driven through applying business model innovation. And what I mean by business model innovation is build businesses that are fundamentally differently structured than the incumbents. And that if you do that right, you can actually build businesses that meaningfully shift the patterns of power and inclusion in the markets in which you operate.
Wow. And I mean, that very fundamentally does build on De Soto's primary premise, wasn't it, around property ownership and title also being key to wealth creation. But in order to do that, one also needs to include more people in the formal financial sector. And I'm aware that at that time at Standard Bank, you were working in exactly that space. You led the strategy to extend banking to underserved consumers and adding digital channels and I believe more than 1 million additional customers to the bank. What did you learn through that period, which is just prior to you forming Tyme then in June 2012?
I would say the two sides of it, of my experience at Standard Bank. The one is that I'm very grateful to Standard Bank and a big fan of Standard Bank and what they've created as a leading institution on the continent. And I learned, how much power can be applied to innovation in a big business like that. But I also learned the limitations of big business and particularly established banks in driving innovation, and learned that typically innovation in large banks will be incremental rather than transformative. And that is just due to the natural limitations of the institution, including its technology choices, its risk and compliance parameters, the trade-offs it needs to make to keep current revenue streams and current customer bases happy. And that ultimately the combination of compromises that you have to do in order to keep the current business healthy and happy. And those are all the right trade-offs to make for the institution. Actually, those very trade-offs undermines that institution's ability to be transformative. And I came to the conclusion after 5 very happy years at Standard Bank that the only way in which we can do something truly transformative is to actually start fresh, is to actually go out and do it from the outside in.
And do you think sometimes it's fascinating, and we could probably spend the rest of the podcast just on this topic of how established businesses need to approach disruption and innovation in a world where, I mean, we're chatting as NVIDIA became just the third ever company to cross the $3 trillion market cap mark. and it was only founded in 1993. It's just a remarkable story and just shows you how quickly businesses are growing and how quickly the world is changing. And I often think when it comes to the incumbents, it's a resource allocation issue sometimes, as much as what you've just described, in that innovative projects, things which are inherently uncertain, maybe unproven or untested, might struggle to secure funding and support over resources or budget that's allocated to areas with more predictable returns. Do you think there's an element of that in the South African context?
There is, and in all other contexts, I ended up as part of the Tyme journey serving on Commonwealth Bank of Australia's Exco for a number of years. And at the time, they were the 10th largest bank in the world by market cap. And what I realized that even in that context, where you have very deep resources, the same kind of resource contention issues come in. And another issue raises its head, and that is that often in the early days, the innovation part of the business looks tiny. It doesn't look like it justifies the attention of senior executives. And it doesn't look like it's going to move the needle for a very long time. Because even if you sort of believe your own, optimistic projections, it still looks like a very small delta on this massive institution and what it's able to achieve. Of course, what happens with all of us, we overestimate the medium term and completely underestimate the secular impact. In other words, what it looks like 10 or 15 years from now.
Yeah.
And so I think those things, together with the fact that many executives are very much incentivized around shorter time horizons, and investors think shorter time horizons. All those things sort of combine to actually weigh against meaningful transformative innovation.
Very interesting. And often then why we find that coming out of something that is built from first principles, often as a startup. And, to the Tyme story, there was a period between Standard Bank and you becoming involved in Tyme where you were with Deloitte. And I believe, in fact, Tyme was spun out of Deloitte as a new venture. Maybe you can just share exactly how that came into being and how the business was then acquired by Commonwealth Bank of Australia.
Yes, it was interesting at the time. Deloitte had a very successful strategy innovation practice led by a guy by the name of Louis Gera. And I sat down with him one day and we said, the way to do something like this, which is we had this ambition from day one to start a digital bank, is to actually start it in an environment where you've got a credible brand behind it and you're able to mobilize significant resources, which the Deloitte innovation practice had, to actually do the best quality thinking right at the start. And the idea was that Deloitte would be a longer term shareholder in the business. So we would start it in Deloitte, we'd spin it out, and then Deloitte would remain a shareholder. But again, international governance around accounting firms tripped us up, because in the process of building this business in and with the Deloitte team, realized that they had an independence issue with one of our suppliers. And we essentially had to make the call either to shut the project down or to spin it out. And so long before we planned to spin it out, we actually spun it out in 2012 into its own business. And at the time, the strategy was to run it as a sort of a banking as a service business, providing banking products to the likes of Pick n Pay and MTN. And then over time to convince our partners to invest with us to actually do a standalone digital bank. But as we were still on that journey with MTN and Pick n Pay, we got this unsolicited approach by Commonwealth Bank of Australia. They literally just pitched up and say, listen, we love what you guys are doing. And they made us an offer we couldn't refuse to buy the business.
Wow.
And to essentially expand the business into their Asian markets.
That's fascinating. Considering the offer was unsolicited, you probably wouldn't have had much detailed due diligence in terms of a go-to-market valuation. So how did you manage that process in that period of ensuring that you were putting a fair value on the table?
As the saying goes, beauty is in the eye of the beholder. We had an idea of what we thought the business should be worth. They made us the offer. It was significantly north of what we thought it was worth. So it wasn't a difficult negotiation. And what they were really buying is they weren't buying our revenues or our profits. What they were really buying was the ideas, the business operating model, the technology, and the team, and what they thought was a team who would be able to help them take digital banking into their Southeast Asian markets.
And then obviously that led you to Hong Kong to lead the digital initiatives for CBA across Asia before then in 2017 being appointed group executive at CBA, responsible then for the international retail banking and insurance business. What did that period teach you before you then partnered with African Rainbow Capital to buy the Tyme business back from CBA in Asia?
First, I think running multi-country banking operation is just a fantastic adventure. I ended up spending time in Mumbai, looking after the branch there, in Hangzhou and Chilu in China, looking after the banks there. I chaired a bank in Indonesia. I was on the board of a bank in Vietnam. And it was just 5 amazing years of getting to know this part of the world well, getting to know regulators and so on. But once again, appreciating the limitations of big business in driving innovation and how, when you're inside a big business, everything you want to do ends up being more expensive, slower, and more complicated than you think it should be. And that is just by virtue of not only the sort of the scale and the number of people involved in everything, but the fact that large businesses have to be more defensive and careful in what they do than startups. So we learned that lesson. If I didn't learn it well in Standard Bank, I had another opportunity to learn the lesson again.
So, that was then reaffirming earlier experience and surely must have informed your resolve to then buy the business out and say, right, we've really got to try and do this as far as possible as we can with shareholders that understand this and will give us the freedom to do it. And clearly, African Rainbow Capital and Patrice Motsepe were those shareholders that helped you then buy the Tyme business from CBA. Why African Rainbow Capital?
They actually came in as the Black Empowerment shareholders into the business when CBA still owned the business. So at the time, they were, I think, maybe an 8% shareholder in the business. So they had already gotten to know us and the business a little bit. And so that made for sort of an easy start to the conversation. But I think more importantly, Patrice and the team are really passionate about building transformative businesses. And here was a team with Johan van Zyl and Charmaine Padiachi and the people who really believed the same things we believed about financial inclusion and the opportunity to do something disruptive, and who had the freedom to actually put significant resources behind it. And it's incredible. We've now raised something in the order of $420 million in this business from when we started. And they followed their rights all the way through. They're still a 51% shareholder in the business.
Wow, that's exactly what you want, is partners who are not just going to follow their rights, but are also deeply passionate about that mission. And, knowing something of African Rainbow Capital through their acquiring of a significant chunk of Alex Forbes, they are truly inspired and purpose driven by a mission to deepen financial inclusion. I think the Alex Forbes investment is similar to that, in that they see the potential here to improve the retirement outcomes of millions of South Africans, and that number of 6% of us retire with enough. And that really is a woeful indictment of the broader retirement industry. Very smart people, populated with actuaries and some of the best and brightest, yet we can't seem to crack this particular nut. And I know, yes, the macroeconomic factors are high unemployment, but there are other things. We just don't preserve our retirement savings. And so they are deeply passionate about this. When it comes to your approach to financial inclusion, before we talk about some of the milestones you've achieved recently with Tyme, what do you see as the overriding opportunity here for Tyme and for South Africa more broadly if we manage to deepen financial inclusion in a meaningful way, such as Tyme is starting to demonstrate can be done through a digital bank such as Tyme?
Michael, what for me is interesting is that if one looks at the research done by the World Bank and other research internationally on financial inclusion, both the macro quantitative, the qualitative impact on people's lives, those things are, I think, well proven. So if you look at the macro impact, what the World Bank tells us is that countries who successfully implement financial inclusion projects add 2 to 3% per year to their GDP per capita, which is phenomenal. If you think about South Africa,
Yeah.
if we can get financial inclusion truly right, it's not just giving somebody a bank account. It includes things like investments, retirement savings, and so on. Adding 2 to 3% growth in this country will be truly transformative for the economy. Then, if you look at a qualitative level in people's lives, all the way back to the research done on Grameen Bank in Bangladesh, through to the research done on our customers more recently by CGAP, the World Bank's research, show how financial inclusion meaningfully improves people's quality of life and give them solutions that take them from being essentially economically excluded or marginalized to giving them the tools to actually fully participate in the economy. And one aspect in particular that we're passionate about is small business finance. So you know that we fund about 60,000 small and micro businesses in this country. And in the last 2 years have doubled our female penetration of that funding. And what that does is it takes small businesses that are undercapitalized by the formal economy, and it actually gives them the working capital they need to grow their businesses and to extract for the business the kind of margins and growth opportunities that are out there to get.
Yeah.
That in particular for me is an exciting part of this financial inclusion conversation.
Absolutely. And I mean, we saw through COVID, didn't we? The fact that we had that COVID grant scheme that was supposed to
Yes.
reach small businesses, but it went primarily through traditional banking channels, and it really should have gone through some of the alternative lenders, as they called. And I know you acquired Retail Capital recently, which was founded by Carl Vestvig, who just, they understand that SME market. They can take a thin file customer and lend to them because they've got different ways of scoring and understanding them. But I want to first start about, the base is underserved because I think the traditional model finds it too costly to serve the base. But with the digital channel, I mean, you mentioned a figure at the recent Beyond Banking conference that your cost to acquire a customer at TymeBank is what, $4?
Correct.
And what is the traditional cost? I mean,
Um,
it's mind-boggling that.
It is. In fact, that number is the lowest CAC that we know of in the world, the lowest cost of acquisition that we know of in the world. The best digital banks internationally tend to be around $7 or so. So Nubank in Brazil, they've got 100 million customers now. They acquire at about $7 a customer. Bank Jago in Indonesia, about $6.50. So $4 is a very efficient number and is at least 10 times more cost effective than the large banks. So you have an order of magnitude improvement on the cost to acquire customers. But at the same time, you actually also have a better experience because to make it cheap, we had to make it hugely efficient. It turns out that a hugely efficient account opening process that takes the customer 3 to 5 minutes actually also really works for the customer and is certainly better than an hour of filling in forms and going back 2 days later to pick up your card.
Yeah, and it seems now, in hindsight, it seems so obvious. What were the challenges to crack that particular nut, to bring that cost to acquire to a point where you're now leading globally?
Yeah, in our design of that account opening process and a lot else that we do, we lean very heavily on the operating model theories of C.K. Prahalad and other people like him. And so the way we do it is we actually design these processes within very, very strict parameters. So for instance, for opening a bank account, we will set the parameter that opening the bank account, we will not allow any paper, we will not allow any wet signatures. We will not require the customer to have any documentation with them. We will not ask the question anything that we can find anywhere else in the world. So if we can find the information anywhere else, we will find it rather than ask the customer. And we want the customer to spend less than 5 minutes on the actual technical process of opening the account. Now, once you've set those parameters, then the design job is then to work out how do you get there? How do you use the best technology in the market to actually fit within those design parameters? And typically, when you start that kind of design process, initially people just tell you that you're mad and that it cannot be done. And then your job is to sort of take those problems one by one and solve them as best you can to get within those design parameters. Yeah, and you do that with other things as well. You do that, we have a loan origination process for an unsecured personal loan that is real time, end to end, straight through process, completely digital. Again, not asking the customer for any documentation, and gives them the answer before they leave the process, whether they've got the loan or not. So those are the kinds of things that you then sort of hope to replicate through all your other processes in the business.
And you've done that despite, I think, many being skeptical initially at this idea of a digital bank being able to service the base of the pyramid. And the skepticism, I think, was founded in the fact that we still see very much in the township and informal economy a reliance on cash, and trust is a big issue. And so if you've got a digital bank, how are you going to build trust with that base of the pyramid in customer and user? And you solved this in a very novel way, because you do have physical presence. You just don't call them branches, but you partnered with Pick and Pay, with other retailers as well. Take me through the partnership concept and strategy, which I think also very much builds on this idea of co-creation that C.K. Prahalad also leaned into in his theories.
Exactly right. So, we're very grateful to Pick and Pay, Boxer, TFG, who've been great partners with us through the years. And the idea was that we don't want to build a digital bank that is just for digitally native, crypto dudes and fractional share traders and gamers and these kinds of people. We wanted to build a bank for everyone, but that leverages digital. So the mindset is not so much that we're going to throw digital at the customer, but we're going to use digital to make the business extremely accessible to customers. And this idea of deploying these kiosks, these digital self-service channels into retail stores was really born out of the fact that customers trust their local retailers, particularly these well-known retail brands, and that if you bring them into the bank through those channels, you almost leapfrog this question about whether this app can be trusted. Because people don't ask the question, is this a real thing, when they're seeing a beautiful shiny kiosk inside the retail store, or the tellers in the store know about it, they can deposit and cash in the store, and simply by association with the store, you actually get that first step into the journey where the customer will at least give you a try and trust that you're not going to run away with their money. And then once they've given you a try, once they sort of in the system, then you can sort of nudge them in all sorts of interesting ways to start using you more and more over time. And so the way to almost think about it is that the kiosk in our world is like the sales and service function of a branch. And we always put next to the kiosk an ambassador. So that would be a person, typically a young, previously unemployed person from the local community, who would be there purely to educate and to explain to customers how the products work. And then you integrate into the checkout counters, into the cash registers for the purpose of cash deposits and cash withdrawals. And that actually replicates the teller function in a branch. But you get it done at a fraction of the cost that a normal bank would run a branch. And that sort of replication of branch infrastructure inside the retail environment is the thing that gives you the best of both worlds. It gives you that physicality, that presence, but it gives you a cost point that, interestingly and slightly counterintuitively, is even cheaper than doing it online. And the reason for that is you don't have to spend all that advertising money online to convince customers that you're real and that you can be trusted.
Yeah. Wow, fascinating. And is this the model that you've used for your impressive growth in the Philippines as well? I mean, 3 million customers in just 17 months is truly staggering.
Yeah, I have to say, Michael, we're pinching ourselves on the Philippines and how successful we are. We just heard from Visa that we're now their number 2 issuer in terms of number and value of transactions in the country. That's a country with 126 banks. So we're stunned by our progress, and we used exactly the same model. And in fact, we've now announced that we're entering Vietnam. We've just switched on our first product in Vietnam, and we're going to use exactly the same model in Vietnam as well.
So expanding at this scale now, with clearly a proven concept, but the ability to scale rapidly, must require a particular skill set from an operations and team perspective, while maintaining this very innovative startup mindset that you've built through time. What are the challenges, leaning into the lessons that you've learned so far, in now scaling this business as it enters a rapid growth period through the J curve?
Michael, we can talk about this for hours. I would say the first thing is that it is all about the people and all about the culture of the business. And, the culture largely gets created by 1% of your people. And those are the people who are trusted to lead the business. So the first thing we do wherever we go into a new market, we make sure that the key people in the operation are our most experienced, most trusted people, so that you can carry the culture into those markets. And then at a practical level, you have to be very disciplined in containing complexity. Because building a bank to start with is complex.
Yeah.
Going to a new market with a new regulator, new cultural nuances and so on, that adds complexity. And that means that the one thing you can't afford is to build complexity inside your business. So what you need to do is to be quite disciplined about what products, what features you do, and what level of variation you allow within your model. And I've always said we'll never have more than 10 products. Now, depending on how you define a product, I think we're still well within those parameters. And the job is to stay there, not to have hundreds of products like you would find in most traditional retail banks.
Yeah, well, and that is, often it's in the deals you say no to that you gain the most value, but it's also in maintaining that focus and not expanding beyond your core competencies. And that is the real challenge as you scale to grow. As you said, we could spend a whole other podcast just talking about this, but I have to have you back on. I've just got to say thank you very much for sharing those insights and your incredible journey into the TymeBank story. I think it's just a testament to the power of innovation and resilience in the financial sector, and I certainly look forward to seeing how TymeBank continues to transform banking and financial inclusion in South Africa and beyond. Take care. To our listeners, thank you for tuning in to the Monocle Banking Podcast. Remember to stay subscribed for more inspiring conversations with business leaders and innovators only on the Monocle Banking Podcast.